Welcome back, everybody. Today I'm revealing my $227,000 dividend growth portfolio because I just love paying and being critiqued by people all across the world. Wait, on this episode of the Build Invest Live podcast, we're walking through my portfolio, including all of my different holdings, the actual strategy that I'm using to pick stocks, the dividend income I'm earning, and the different account types and tools I'm using now that I've mostly transitioned over to Schwab. So let's get into it. Sharing your portfolio online can definitely be scary for sure because you're opening yourself up to everyone's opinions and critiques. But I do think it's helpful to be able to see real positions and performance when it comes to investing. Otherwise, everything's just theory. There's lots of channels and content out there where people talk about what ifs but don't put any real money behind it. And it's easy to have a strong opinion about something when you don't have any skin in the game. So I like watching those channels that actually show their portfolios, actually show their performance, because I think it's helpful. So my whole motivation with this is that hopefully it helps because you guys get to see what I'm doing, you get to see what the results are, and you know that the stuff I'm talking about isn't just something I made up. Plus, it helps to keep me accountable to my own strategy because I know that I'm going to have to report back and tell you guys what's going on. So before we get into the portfolio, let's talk about what I'm trying to accomplish with it, because I've talked about this many times. There is no one best investment. There's only the best options available depending on what you're trying to accomplish. So we should always start with investment strategy anytime we think about what our next investment's going to be. So here's my dividend growth portfolio strategy. The goal is to create a portfolio that beats the S&P 500 and creates a growing passive dividend income stream for my family. And that's it. Pretty simple, right? Now, actually achieving the goal is a little bit more complicated, but the goal itself is pretty simple. I want to beat the S&P 500 and create an income stream. So what am I looking for in companies to be able to achieve that goal? Let's break it down. 1, they're generating healthy and growing cash flows. 2, they're efficiently generating their profits. So things like return on equity and profit margin. 3, they're rewarding shareholders with dividend growth that outpaces the rate of inflation, and they're buying back shares. And 4, they have a wide economic moat. And so now that I have the criteria locked down of the type of companies that I'm looking for, the last part of my strategy is, when do I buy these companies? And in general, what I look for is buying these companies whenever they're undervalued relative to the cash flow that they're generating. And for me, that shows up most easily in the price to cash flow measure. And obviously, anytime that I'm looking at a company, I'll go through the whole valuation process. But one of the things that I like to do to make it easy on myself is I actually created a little view in Seeking Alpha so that I can just get a quick idea of how companies match up to my criteria. So what I added to this view is the price to free cash flow, the 3-year revenue growth, the 3-year free cash flow growth, and the free cash flow margin, plus return on equity, net income margin, dividend yield, and the 3-year dividend growth. So what I like about this view is it gives me a real quick way to see if the companies that I'm holding are starting to get away from the criteria that I want, or the companies that I'm watching, they're starting to meet my criteria a little bit better. So that once they do, I can do a deeper dive and understand if it's something that either I need to buy or maybe it's time to look at getting rid of a position. Okay, but if you guys have been watching my videos, you've already seen my portfolio in Seeking Alpha, so that's not really anything new. But I've been consolidating my accounts over to Schwab to hopefully get a more holistic view as to what I'm holding across multiple accounts so that I can share it with you guys. And that's what I wanted to start to do today. So if we go into Schwab, we see that I have a total of $227,379.26 in the accounts that I've included in my dividend growth portfolio. And it's basically in these 5 accounts. So I have the dividends account, which is my taxable brokerage, has a little under $20,000 in it currently. I have a business 401k, which has over $93,000 in it. A traditional IRA, which has over $77,000 in it. A Roth IRA, which has literally $78 in it, so there's not much there.
I get $25 in 1993, so that'll be good. Ooh.
And then my HSA, which has over $37,000 in it. And it's this bundle of accounts that I'm using with my dividend growth strategy. Now, we do have some other accounts that I don't really talk about a lot, like my wife's retirement account is just 100% S&P 500 index, but the ones that I'm using specific to this dividend growth strategy that I make videos about is right here. And now you might be wondering, why do you have all these things spread out across all these different accounts? There's 2 reasons for that. One, in some cases, I just had these accounts at other brokerages and I was consolidating them all in and bundling them all into one investment strategy. But the other reason is that I wanted to make sure that I had a variety of accounts in this portfolio because as I'm making videos on the channel, I want to make sure that I'm thinking about all these different nuances. If it's a taxable account versus a retirement account versus an HSA, they all have different restrictions, requirements, and tax implications. And so by having all these things in this same dividend growth portfolio, then it means I need to keep up with all that stuff and I can share it as I'm making videos for the channel. So let's get started by looking at the holdings in my portfolio. So being able to see all the holdings in one place, regardless of what account they're in, is great because I have shares of Apple and other companies in multiple accounts. And this gives me a nice view of the overall weight and exposure that I have in each company, regardless of which account it's in. Now, altogether, I'm at about 10 holdings in this portfolio right now, and that's about where I want it to be. I don't want it to get much bigger than that because I want to make sure that I'm staying in tune and monitoring all the companies that I'm invested in. Now, let's run through each one and talk about them a little bit. So Apple, I just bought Apple at the top, and that's been a good conversation in the comments this week. But that's going to be a fun one to monitor to see how impacted any long-term gains will be by the entry price that I got. So I don't think we need to talk about that. We've talked about that enough. American Express, that's another one I've touched on quite a bit. I started buying American Express, I think in the 140s, and they've jumped up quite a bit since then. But their price to cash flow is still pretty good. And so I've continued to buy, which has actually pushed down my overall return, at least for now. Next up is Berkshire Hathaway. And I had a great question in one of my videos where someone said, wait a minute, if you're building a dividend portfolio, why do you have Berkshire in there? Because they don't pay a dividend, and they never have. Correct. The only reason why Berkshire's in here, I have 2 shares of Berkshire just in case I want to go to the annual shareholder meeting every year. Then I have my free tickets with my 2 shares. Next up is Lowe's. So Lowe's was one that I actually bought in December, and they've been one of my better performers, but they're a little bit tough out of all these because I actually think when I look at their fundamentals, they're one of the ones where I'm a little bit concerned as to where things are trending, but they've been such a strong performer over such a long period of time that I'm probably going to give them the benefit of the doubt until something more drastic changes in their business. But that's one that I'm definitely starting to watch. Next up, McDonald's. I've talked about this one a bunch. I don't need to touch on it again, but I love the company. I love the stock. That may actually be the last stock that I ever sell. Okay, Realty Income. So I just did a video on the valuation of Realty Income, but you might notice that I only have 1 share of Realty Income in my portfolio. And you're probably wondering, what the heck is that all about? Well, I made a video a couple weeks ago about how to buy your first stock, what a market order is, what a limit order is. And in that video, the account that I was using had just enough money to buy 1 share of Realty Income. So that's what I did for the video. So there's my 1 share of Realty Income, just compounding every month like a beast. And in about 250 years, it's going to be rolling. Next up, United Healthcare. United Healthcare is really one of the feel-good stories for me so far this year. There's a stock that I've been looking at forever, and I just never pounced on it. And I was patient, and I waited, and it had a nice dip earlier in the year that I actually bought. And it ended up being a really good entry, and it's already performed pretty well in the short time that I've held it. I'm a believer in United Health. They've had a great history, and we'll see. They have a little bit of headwinds coming up in the healthcare industry, but I am really confident in that position, and it's one that I plan to hold for a long time. Next one is Valero. So I've talked about Valero multiple times, and they're just one of my favorite stocks. I mean, they're a great performer in terms of execution, and I'm excited to see what happens with their dividend growth going forward, especially with how their cash position looks right now. And Valero is another one where I felt like I stuck to my strategy pretty well, and it met my criteria. It was undervalued as it relates to price to cash flow, and I got in at what I felt was a really good entry. And being able to do that means that I've already enjoyed some returns in this recent run-up while I still believe in it as a long-term hold. And the last individual stock we'll talk about is Walmart. So Walmart was the one that didn't actually meet any of my criteria when I bought it, but I like what they're doing, and I'm anticipating growth in their free cash flow and dividends coming soon. Now, if not, this may be one that I keep an eye on just to see if it doesn't meet my investment thesis or my prediction of what it was going to do, then I may have to look at it again. And then lastly, SCHT. So I have a portion of my portfolio just in the SCHT ETF, which it shows good dividend growth and I think is generally undervalued at the moment in aggregate, even if I'm not a huge fan of some of the companies in the index at the moment. Verizon. But in general, I do believe in the criteria of the underlying index of SCHD. Trying to find dividend payers who might be undervalued right now and show good dividend growth is something that I'm looking for. And so it's a nice way to balance my portfolio with my individual stock picks with just a percentage that is a basket of those companies that should also show the dividend growth that I'm looking for. And then down here, it shows I have cash of $37,000. That's not actually cash. That's actually 492 shares of SCHD that I'm holding in my HSA right now. But currently, my HSA is still at TD Ameritrade, and it's transitioning over to Schwab here over the next month or so. And so once that does, it should show up here in the SCHD column as opposed to cash. So it's just a little weird right now, but it'll get fixed in about a month. And that's another reason why I'm excited for that transition from TD Ameritrade over to Schwab. Okay, so let's take a look at investment income. So this investment income page is nice because it shows me what dividend income I should expect with the stocks that I'm currently holding. And so when I look out over the next 12 months, you see it has an estimated income of over $3,400. Now, part of the challenge here is that my HSA is not included in this number yet because it's still at TD Ameritrade. But including those additional dividends from my HSA, it would be an additional $1,279 a year, which would have the total at about $4,694 a year, which would put me a little above 2% dividend yield for my portfolio. And I know you must be like, wow, what a scam. You have a $227,000 portfolio and you're getting less than $5,000 a year in dividends. You suck. But the point of this portfolio strategy is not to maximize dividend yield now. It's to have dividends that continue to grow over time, yield on cost continuing to grow over time, so that by the time I get to that retirement age, those dividend yields and that dividend payout looks a lot better. Okay, so let's look at portfolio performance. Now, I really love the tools within this portfolio performance tab because it allows me to see my full portfolio in aggregate and then try to get some insights as to how it's performing and what it's made up of. And as you see here, they have a value versus net contributions graphic. And this really isn't that valuable to me right now because I've been moving accounts around, so the values are all messed up as I've moved money and securities in and out of these accounts. So it doesn't really give me a clear picture of where I'm at today. Plus, the HSA is not included either. So once that transitions over, it's going to spike up again. But as we get into next year and all that kind of levels off and settles down, then that'll start to become valuable for me. Then over here on the rate of return graphic, I love this because it gives me the ability to see very quickly how my performance matches up against the S&P 500, which is one of the goals that I stated, right? That I wanted to outperform the S&P 500. Well, the nice part about this is it allows me to consolidate all these accounts, all these positions, and then be able to see how I'm doing against the S&P, which I'm not doing great, right? I mean, I'm underperforming the S&P by quite a bit, which I already knew that. Now, I started this portfolio in early December, technically. So if I go back to early December, it's slightly better, but not by much. I think I started it like on the 5th or the 9th. And so if I go all the way back to December, my rate of return is basically the same. The S&P actually is down a little bit. So the net outperformance compared to my portfolio is not as bad. But at the end of the day, I've underperformed, and that's all there is to it. I'm only 9 months into it. So it's not like anything that I'm too worried about at this point. And we'll see what happens between now and the end of the year. Now, if we look at portfolio details, we get access to this portfolio checkup. And portfolio checkup is just where we can look at a bunch of tools that Schwab provides to be able to analyze your portfolio. Now, you may use them a lot or may not use them at all. I use them in general just as a guide to maybe spark some ideas in my brain of stuff that I need to go look at. But it at least is nice to have just in case you want to dig into it more. So I'm primarily invested in large cap equity and small cap equity, and that's probably not going to change much for me because those are the type of stocks that I'm actually interested in investing in. I'm not really interested in international, and I don't really want to do anything with fixed income, at least at this point. So in terms of sector diversification, it tells me that I'm doing okay. In my opinion, the only one that I kind of worry about sometimes is consumer discretionary, just because I have McDonald's and Lowe's both in that category, but they've both been such good performers that, again, I'm not going to overreact to anything until I see some real kind of drastic or fundamental changes in their businesses. And then you have other things here, equity concentration, and then quality. And apparently it thinks all of my stocks are okay, except for that one share of Realty Income, really bringing me down. So overall, I really like where I'm at in my portfolio right now. Obviously, I am underperforming my benchmark of the S&P 500 up to this point, but we're still early in this, and we'll see what happens between now and the end of the year. And this is going to be a long, multi-year kind of journey, and we'll see how I do. I'll plan to continuously update and show you guys how it's doing every month, and we'll continue to talk about my thought process of when I get in and out of any positions, and hopefully it helps you and me become better investors. Now, if you guys have any questions about my portfolio or how I set it up, put them down in the comments below. Thanks for tuning in to this episode of the Build, Invest, Live podcast. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.